Today, we will know what is a stock market and our experts will explain it to you in detail.
Welcome to the deep dive. Today we're peeling back the layers on something you definitely hear about all the time, the stock market.
Absolutely. It's everywhere.
Right. Most of us know of it, maybe even have some money in it through, retirement
Or
fund.
maybe direct investments, yeah.
But what's really going on underneath, beyond the headlines, the ups and downs, that's our mission today. We want to cut through the noise, really help you grasp the fundamentals.
It's a topic that touches everyone, but yeah, it's often misunderstood. There's this mystique around it sometimes.
Definitely.
People see the flashing numbers, the charts, but our goal here, using our research, is to demystify it. Show how it works, why it matters so much.
And here's the first big thing, maybe the most important takeaway. When you buy a stock, you're not just clicking a button.
No.
You are literally buying a small piece of ownership, a stake in an actual company.
That's the core of it.
Think about that. It's a real connection. And this deep dive, we're aiming to make that whole world feel, well, a lot clearer for you. Okay, so let's start basic. What is the stock market exactly?
Good starting point.
Our sources describe it as basically a collection of marketplaces. Lots of them, all linked together.
Yeah, interconnected.
It's where buyers meet sellers. And they trade shares, those pieces of ownership in companies that are publicly listed.
You can almost picture it, right? Like a huge bustling market. But instead of, spices or textiles.
It's ownership being traded, stakes in huge companies.
Precisely. And that ownership idea, it's key. You buy a stock, you become a shareholder. You literally hold a part of that company.
Okay.
Now, why do companies do this? Why sell off pieces of themselves? It's about raising money, what we call capital.
Capital.
It's the fuel they need for running the business day-to-day, for expanding, for R&D, developing new things. It's their lifeblood for growth and innovation.
So it's like how a startup might look for investors to get off the ground. But on a massive scale. Instead of a few angel investors, they're tapping into potentially millions of people globally.
That's a great analogy. It's a way to access huge amounts of funding to pursue really big projects. And it's different from, say, just getting a loan from a bank.
How so? What's the difference there?
Well, with a loan, you're taking on debt. You have to pay it back, usually with interest, on a fixed schedule.
Okay.
When a company issues stock, they're selling equity. They're bringing on partners, essentially, shareholders. It gives them more flexibility, maybe to invest in longer-term, riskier things that a bank might shy away from.
Okay. Less pressure for immediate returns, maybe? More focus on the long game?
You could say that. It's a fundamental tool for corporate growth, especially for ambitious, sustained expansion.
Got it. Now, you mentioned companies selling shares. Is it always the same process? Or are there different stages?
Great question. No, it's not all the same. There are really two main stages, or markets. First up is the primary market.
Primary market, okay.
This is where a company's shares are sold for the very first time, like the debut.
Big launch.
Exactly. And the main event here is something you've probably heard of, the IPO, the initial public offering.
IPO, right. That's when a private company decides to go public.
Precisely. They offer their shares to the public, raise that initial chunk of capital.
Okay, so that's the first sale directly from the company. What happens after that?
Right. So once those shares are out there, bought by initial investors in the IPO, they then move into the secondary market.
Secondary market.
This is where most people interact with the stock market day to day. Think of the big exchanges, the New York Stock Exchange, the NYSE, or NASDAQ.
The ones you see on the news.
Exactly. But here's the crucial difference. In the secondary market, you're not buying shares directly from the company anymore.
Oh, right.
You're buying them from another investor who already owns them and wants to sell. Or you're selling your shares to another investor who wants to buy.
So the shares are just changing hands between investors.
Correct. The company itself isn't directly involved in those secondary market transactions. The money goes between investors.
So if I go buy, Apple stock today on my brokerage app, that money isn't going straight to Apple's bank account for their next iPhone design.
Nope. Whoever sold you those shares, Apple got its money back when it first issued those shares maybe years ago in its IPO or a later offering.
Okay, that's a really important distinction. The primary market is the company raising funds. The secondary is Liquidity, letting people trade.
Exactly. Liquidity and price discovery. The secondary market lets investors buy and sell easily. And, the fact that there is a liquid secondary market, that's actually what makes the primary market work.
How so?
Well, who would buy shares in an IPO if they thought they could never sell them later?
Good point. You need an exit route.
Precisely. Knowing you can likely sell your shares later on the secondary market gives investors the confidence to buy in the primary market during the IPO. They're linked.
So, for you, the listener, this means thinking about whether you're looking at a brand new company hitting the market or trading shares of a company that's been public for a while. Different dynamics. Okay, this is making sense. But now, the big question, maybe the one that feels most mysterious. How do stock prices actually get decided? They go up, they go down, sometimes wildly. What's driving that?
Yeah, this is where it gets really fascinating. It can seem chaotic, right?
Totally.
But at its absolute core, it boils down to one of the most basic economic principles there is: supply and demand.
Supply and demand, like the same thing that affects, the price of avocados.
Fundamentally, yes. It's the same core logic. If more people want to buy a specific stock than want to sell it, well, that's high demand, relatively low supply.
So the price goes up.
Exactly.
Why?
Buyers have to offer a bit more to convince sellers to part with their shares. They bid the price up.
And the reverse.
The reverse is also true. If lots of people want to sell their shares, but not many people are eager to buy them, that's high supply, low demand.
Price drops.
Price drops. Sellers have to lower their asking price to attract buyers and offload their shares. This constant push and pull, happening millions of times a second across thousands of stocks, is what creates those price fluctuations you see.
It sounds so simple when you put it like that.
The principle is simple.
Like, think about concert tickets for a super popular band. They sell out instantly.
Right.
And suddenly on resale sites, the price is way higher. That's high demand, limited supply.
Perfect analogy. Or if a company makes way too many fidget spinners after the craze dies down,
Right.
they'll have to slash the price to get rid of them. High supply, falling demand.
So stock market is just that, but for company ownership.
It is, but,
Yeah.
and this is a big but, it's way more complex in practice.
Okay. How so?
Because the reasons for that demand and supply changing are incredibly varied and, frankly, sometimes not entirely rational.
It's not just about the company's actual performance.
That's a huge part of it, yes. Company news, good earnings reports, new product launches, scandals, that all matters. So does broader economic news like interest rate changes or unemployment figures. Geopolitics plays a role. Analyst ratings.
Wow. Okay. Lots of inputs.
And then there's investor sentiment. Just, the general mood. Optimism can drive prices up. Fear can drive them down. Sometimes, regardless of the underlying facts, fear of missing out, FOMO, is a real thing in markets.
So psychology plays a big part too. It's not just cold, hard numbers.
A massive part. Plus, you have sophisticated algorithms trading huge volumes based on tiny signals humans might miss. It all feeds into that supply and demand equation, making it incredibly dynamic and sometimes unpredictable.
Okay, so we've got the mechanics. Ownership, capital, primary and secondary markets, supply and demand driving prices.